Christchurch's High School, Te Kura o Hiniwaiora, we recommend dropping the OCR by 25 basis points from 5.25% to 5% in the October Monetary Policy Review. CPI is currently at 3.3%, following 2 years of tight monetary policy. However, this is still above the Reserve Bank's target range of 1 to 3% and still a significant way from the midpoint of 2%. In the household sector, consumer confidence has just begun to trend upward following a long period of decline, driven by improving expectations, less negative media coverage about rising costs of living, and recent decreases in interest rates. We don't think this sector will have significant inflationary pressures in the medium term as households consolidate their financial positions. In the housing market, the Reserve Bank's addition of debt-to-income ratios to its loan-to-value macroprudential tool is thought to be useful in ensuring that house prices will not accelerate significantly as interest rates ease in coming months. The Overseas Investment Amendment Act, which restricts foreign ownership of residential properties in NZ, also continues to dampen demand for housing. Around 60% of Kiwis own their homes, and around 2/3 of which have a fixed-term mortgage on their property. Consequently, it will be many months before they benefit from falling interest rates and longer before the full impact of the August cut in the OCR and retail interest rates has an effect on household spending. Projections indicate that annual net migration will slow to near zero by the 2025 calendar year. This decline is primarily attributed to a reduced appeal due to fewer job opportunities, the fading post-pandemic surge, and changes to immigration policies. This will take further heat out of the economy, both through lower demand for goods and services and lower demand for housing.
In the business sector, lowering interest rates have improved confidence about future sales and profits. This is reflected in their future plans, with investment intentions rising from a negative outlook when last surveyed to a net 7% of firms looking to increase investment and a net 12% of firms looking to increase employment in coming months. Since the output gap is more negative than previously thought, with spare capacity and relatively high unemployment, we do not believe these increases in employment and investment will create any inflationary pressure in the medium term. The producer price index rose in the June quarter, mostly due to rising costs of electricity and gas prices. In some industries like construction and product manufacturing, the cost of materials, machinery and metals have also increased. The labour cost index has also been increasing, which could indicate some ongoing inflationary pressure through this sector.
In the domestic economy, the unemployment rate continues to climb as declining economic growth results in fewer jobs being available and competition has increased with larger numbers applying for fewer positions. Employment data shows 4 straight months of decline in filled jobs. Unemployment is expected to surpass 5% by the end of 2024 or sooner, according to some economists' estimates. This will lead to decreased aggregate demand, and the greater output gap means less inflationary pressure due to decreased wages as the economy is further away from capacity. The 2024 budget includes clear directives for government departures to reduce expenditure both immediately and over the medium term. This will contribute to lower aggregate demand and lower economic growth, and some reduction in the demand for labour and other resources. The operating balance is projected to steadily improve, returning to a surplus in 2028. However, some of the reduced central government spending on water reforms, along with transport and other infrastructure, is pushing some of these costs onto local government bodies who are having to increase rates to cover their costs. The government is also looking to increase revenue by increasing many fees and levies, although at the same time, recent tax cuts have offset the impact of some of these increases in costs to households. These charges, in addition to rising insurance costs, do seem to be contributing to some non-tradable inflation risk, but how this and the income tax cuts will impact on the rate of inflation over coming months is yet to become clear. Interest rates in the USA are predicted to decrease with the weakening economy there, so the New Zealand dollar is likely to at least hold its value and possibly appreciate slightly, and so there is unlikely to be the inflationary pressure that would occur from export receipts and higher import prices if the New Zealand dollar weakened.
Growth amongst our major trading partners remains subdued. In the US, growth is projected to slow in 2025 to 1.8%. In China, the GDP growth is projected to slow moderately to 4.5% in 2025. In the euro area, GDP growth is projected to increase only slowly from 0.7% this year to 1.5% in 2025. In Australia, the GDP growth will also only increase slowly to 2.3% next year. This means there isn't expected to be much change in commodity prices or demand for our exports, and so there will probably not be as much inflationary pressure from overseas. There is also likely to be downward pressure on import prices from low global demand, contributing to lower tradable inflation in New Zealand. New Zealand's economy faces many geopolitical risks globally. Conflict in the Middle East could disrupt shipping routes like the Suez Canal, increasing shipping costs, which have already seen the World Container Index increase by 235% since early 2024. Disruptions have also reduced the number of ships sailing to New Zealand, so exporters face increase in costs to get products to market. The US election is another risk area for New Zealand, with the possibility of higher tariffs and restrictions on global trade potentially increasing costs and commodity prices. The war between Russia and Ukraine has the potential to escalate, creating further disruptions to trade in commodities like wheat and oil, potentially pushing up prices of these essentials. These situations all have the potential to add to inflationary pressures in New Zealand and might require a slowing of future reductions in the OCR.
Overall, our view is that inflationary pressures have eased across the economy in response to tight monetary policy over the past 2 years. Household consumption, business investment, government spending, and net exports have all weakened, reducing aggregate demand and inflationary pressure. Monetary policy has been doing its job, however there is now a risk that keeping interest rates too high for any longer could cause a slowdown and be unnecessarily disruptive for households and businesses. We therefore recommend a reduction of 25 basis points at this time. We considered a 50 basis point reduction, but at 3.3, the rate of inflation is still quite a way above the 2% midpoint target. We also considered not changing the OCR at this time, but thought this could cause household consumption and business investment to stall, risking another fall in real GDP and economic growth.
Yay!